Our next topic is time frame analysis. But before I talk about that, let's talk about 3 important reasons why you should be trading price action. The first, price action represents collective human behavior. The second reason is that price action gives structure to the forex market. The third reason is price action helps reduce noise and false signals. Now I'll explain the first one, which I said price action represents collective human behavior. Human behavior in the market creates some specific patterns on the chart. So price action trading is really about understanding the psychology of the market using those patterns. That is why you see price will hit a support level and then bounce back up, and also price hits a resistance level and then heads down. Why? Because of collective human reaction. We will soon get to talk about support level and resistance level. Just follow me as we proceed. We will make progress. Let me explain the second one, which I said price action gives structure to the forex market. Now you can't predict 100% accuracy where the market will go next. However, with price action, you can to an extent predict where the market can potentially go. This is because price action brings structure. So if you know the structure, you reduce the uncertainty to some extent and predict with some degree of certainty where the market will go next. The third, which I said, price action helps reduce noise and false signals. Now, if you are trading with the stochastic or CCI indicators, they tend to give false signals. This is also the case with many indicators. Price action helps to reduce this kind of false signals. Price action is not immune to false signals, but it is a much better option than using other indicators which are essentially derived from the raw price anyway. Now, price action also helps reduce noise. Now, what is noise? Market noise is simply all the price data that distorts the picture of the underlying trend, that is to say, the trend currently going on. This is mostly due to small price corrections as well as volatility. And one of the best ways to minimize market noise is to know your time frames. Let's now begin time frame analysis. Basically, we have 9 major time frames: the 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, 1 day, 1 week, 1 month. Now, these are the major time frames that 99% of forex traders use. One of the best ways to reduce market noise is to trade from larger time frames instead of trading from the smaller time frames. Now look at this chart to see what I mean. The chart has too many little price movement fluctuations. The 5-minute chart has too many candlestick bars, which we will talk about candlesticks soon, and it makes it hard to know the main trend. Is it going bullish or bearish? And this question will be hard to answer using the 5-minute chart. Now let's compare the market noise in the 4-hour chart with the 5-minute chart we checked. Smaller time frames tend to have too much noise, and many traders get lost trading in smaller time frames because they do not understand that the big trend is in the larger time frames, and it is the one that actually drives what happens in the smaller time frames. Having said that, I do trade in smaller time frames by using trading setups that happened in larger time frames. I do this to get in at a better price point and keep my stop loss tight. This is called multi-time frame trading, and I will also cover this topic as we proceed, so I will show you exactly how it's done. You should know that one candlestick in the 1 hour time frame is equal to 2 candlesticks in the 30 minutes time frame. Why is that? It's simply because the 4-hour time frame will produce one candlestick, while the 1-hour chart will produce 4 candlesticks if they are compared together. Now if you circle one candlestick in a 30-minute time frame, you will see 6 candlesticks in the 5-minute chart. So the higher the time frame, the lesser the candlestick you will see. And so because of this, the higher the time frame, the lesser the market noise. Now here are 2 reasons why I use multi-time frame analysis and trading. Now there are 2 main reasons why I multi-time frame trade. The first is for getting better trade setups. The second, for reducing stop loss distance, so I have better risk to reward ratio, which means I can also increase the amount of contract I trade without risking more of my trading account. So if my direction is right, I make a lot more money. Now I will explain both in detail. Now, how to get better trade entries and to reduce your stop loss distance with multi-time frame analysis and trading. If you are trading strictly using the large time frames like the daily chart, your stop loss distance will be huge, and the issue with that is your risk to reward ratio can be reduced. Let me explain what risk to reward ratio means. Investing money into the investment market has a high degree of risk, and if you are going to take the risk, the amount of money you stand to gain needs to be big. If somebody you trust asks for a 50,000 naira loan and offers to pay you 60,000 in 2 weeks, it might not be worth the risk. But if they offer to pay you 100,000 naira, the risk of losing 50,000 naira for the chance to make 100,000 might be appealing. So in that case, your risk to reward ratio will be 1:2. So if you decided that you want to minimize your stop loss distance, even though you are trading with a setup in the daily chart, for your trade entry you should switch to the smaller time frame and watch for a sell signal in the 1-hour time frame. Let's study a chart to make you understand what I am talking about. Now here is the thing about larger time frames. They cover up trading setups that are happening in smaller time frames that could be really reliable trading setups. A lot of traders actually flock to low time frames, and these kind of systems have 2 major problems. One, they use low time frame, which picks up the intraday noise of the market, making it hard to get a clean read on the chart and do accurate technical analysis. The second, price action trading is hard to follow up with a lower time frame. I typically don't take trading decisions based on price action of a chart less than 15 minutes. However, the 1-hour chart is more meaningful. The 4-hour chart is better. The daily chart is even better. Now, price action trading is about trading with an edge. Now, what is trading with an edge? It simply means you need to trade when the odds are in your favor. Now, what are these favor? Trading with the trend, trading with price action, using reliable chart patterns and candlestick patterns, trading using support and resistance levels, making your winning trades larger than your losing trades, waiting patiently for the right trade setups and not chasing trades, and lastly, trading only on larger time frames. Notice I enlarged the last one because that is the topic we've concluded. Now all these things are what helps you to trade with an edge, and these are what separate losers from winners. Now on this video I want to show you the time frames that we have. This is the first time I'm recording my screen and you're seeing a forex chart on this course. Now I just want to quickly show you the time frames that we have on our chart, and if you click at this point you can see all the time frames that are on the TradingView platform. This website is the tradingview.com. Most traders use this website for accurate analysis, and if you could look at this place in particular, you will see that I'm currently viewing at the Euro USD currency pair. Here it only gives me the short form, which is EUR USD, but below it you can see it in full, Euro versus the US dollar, and beside it here you see that this is the 1 month time frame. And at this point you can see this place is blue. It means that this current chart that I'm on is the monthly time frame, and these are all the time frames that we've mentioned. This is the 1 minute, the 5 minutes, the 15 minutes, the 30 minutes, 1 hour, 4 hour daily, and then the weekly chart. And if you click this place you can see other time frames, but not much traders do use these ones, 2 hours, 3 hours, and then the rest. And for now this should be the major time frames you should be concerned about, and we'll get to look at these tools as we move on with the lesson, on all of these tools and what they do and how they will help us to analyze our charts accurately so that we'll get better entries. I mentioned earlier that a lot of traders do try to use the low time frames like the 1 minute chart or the 5 minute chart or the 15 minute chart for their analysis, which is not good as a price action trader. I told you that it's good to analyze the market using high time frames like the 4-hour chart, the daily chart, the weekly chart, or the monthly chart. Now this chart helps reduce false signals and it helps reduce market noise. Now if we take a look at the 1 minute chart, you see that the chart is quite different from the daily chart. On the 1 minute chart you see a lot of fluctuations, which is not good. You will find it very hard to analyze the market and try to understand what is really going on here. Same thing with the 5 minute chart. The fluctuations are just too much. If you begin to go back to the 30 minutes time frame, you will begin to see that the chart are beginning to get more meaningful. We have this downtrend from this point to this point. From here we have this uptrend move, and from this level we have this downtrend move again. But on the 1 minute chart it will be very difficult to get to know the current trend of the market, and using the 4-hour is more meaningful, because using on the 4-hour chart you can get nice entries on the forex market. You can see the arrow that we earlier drew here. On this arrow we only have let's say not more than 20 candlesticks here, or let's say 25 candlesticks. But on the 5 minute chart, if I should go back to where we drew it, we will see a lot of candlesticks here. I earlier told you that on a 5 minute chart each candlestick represents 5 minutes. It takes 5 minutes for each candlestick here to form. And if I go back to the 30 minute chart, each candlestick here also took 30 minutes to form. Same thing with the daily time frame. It took a whole day, 24 hours, for each candlestick to form. Same thing with the monthly time frame. So now the higher you go, the lesser the candlesticks, and the lesser the candlesticks, the less the market noise. Because this is the 4-hour time frame. Each candlestick represents 4 hours. If I should use this ellipse to circle one candlestick here on the 4-hour, you can see if I should zoom it, now I've circled this one candlestick, which it will take 4 hours to finish for me, and beside it you can see the minutes or hours remaining for it to finish for me. On this case, we have 16 minutes, almost 30 seconds before this candlestick will finish for me. Same thing goes with the rest. Now if I should go back to the 1-hour time frame, you will discover that this one candlestick will produce 4 candlesticks, because on the 1-hour time frame, one candlestick of the 4-hour time frame will produce 4 candlesticks. Now if I go back to the 1-hour time frame, you can see that we have gotten 4 candlesticks here. We have 1, 2, 3, 4. It should be like this. Yes, it's like this. Here are the 4 candlesticks that formed 1, 2, 3, 4. Same thing goes for the 30 minutes time frame. Each of these candlesticks will have 2, 4, 6, 8. If we should go back to the 30 minutes time frame, we'll have ourselves 8 candlesticks. Now good, we have 8 candlesticks, 1, 2, 3, 4, 5, 6, 7, 8, and this is the last one that is currently forming. That is how simple a time frame analysis is. I will upload a video, a bonus video about how I multi-time frame trade and how I get better trade entries using the high time frame and the low time frame.